You're live.
I thought it was going to be really.
Thank you. Good afternoon. My name is Senator Michael Jackson, District 27, along with my co-chair, Catherine Forbes. Today we have our Joint Committee on Pensions meeting on here today, Thursday, December 7th, 2 p.m. or roughly thereabout. Call the meeting to order. Today's agenda consists of a decisions section, an annual state retirement and pension system investment overview, closing remarks, and then adjournment. So we can, Delegate Forbes, Madam Chair, would you like to make some opening remarks before I do and we get started?
No, I thank everyone who did the work to prepare us for this meeting and everyone who's in attendance. Thank you.
Thank you very much. We certainly could not conduct these meetings without you. This is our last for the year before we go into session. So we're excited about getting the meeting started. Philip?
Thank you, Mr. Chair. So the first item we have is the decisions on the legislative proposals, and I will be my co-counsel and I will be splitting, going back and forth a little bit, and we're going to have Joe kick us off with the first few.
Thanks, Philip. Good afternoon, everyone. The first item is relates to personal statement of benefits, PSBs for short. And this one would simply allow the board, would clarify that the agency can use its online portal, MySRPS, to satisfy the requirements in statute that the board provide each member of the system a summary of benefits accrued. And this is kind of an existing practice already, and it would simply codify that.
Okay, so Philip, do we need to take a vote, or are we?
Yeah, usually we'll just take them one by one. So after we're done walking you through each one, if there's a motion and vote.
Okay. All right. Cool. Thank you. Next.
Okay.
So,
Philip,
did you want us to make a motion and vote on this one?
Yeah. If we can.
I'm sorry, I misunderstood you. I'm
Sorry.
sorry. Could I have a motion?
I motion that we do option A. The joint committee will sponsor the legislation.
Can we get a
I'll
second?
second.
Right. Any discussion, further discussion? Seeing none, all in favor say aye or raise your hand.
Aye.
Aye.
Any opposed? All right, let's move on. Thank you.
the next item is a technical change to the cost of living adjustment COLA provisions. Currently, the definition of CPI in statute refers to an older index from 1967, but that one is the board is, or the agency is concerned that that one will be retired by the Bureau of Labor Statistics sometime soon. And there are a number of areas already in Maryland statute that reference the most recent index, which is the 1982 to 1984 index. So this one would amend the definition of CPI to reference the most recent index, CPI index, the 1982 to 1984 index.
All right, thank you. Any questions? Could I get a motion?
Motion to do option A. The joint committee will sponsor the legislation.
Second.
And motion has been made in second. Any discussion? Seeing none. All in favor signify by raising your hand or saying aye. Actually, voicing
Aye.
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 Any opposed? Seeing none. Thank you very much. Next.
All right, the next one is a technical change to correct an erroneous reference to a mandatory retirement age from a chapter 400 enacted this last session, it's 2023 session. It was a drop bill, deferred retirement option program bill that extended drop for both state police retirement system and LEOPS from 5 to 7 years. But in the second section of the bill, It referenced a mandatory retirement age of 60, which is only in existence for the state police retirement system, not for LEOPS. So this would be a technical correction to remedy that.
All right, thank you very much. Could I get a motion?
Well,
Um,
I had a question.
Delegate Metzger?
Question is is LEOPS okay with this?
The request came from them, Delegate.
Okay, okay. That's
It's a
fine.
technical fix.
Okay.
Yes. So
I'll make a motion that the option A, the joint committee will sponsor the requested legislation.
second. Could I get a second from someone?
Second.
Thank you. Any further discussion? Seeing none, all in favor, signify by saying aye.
Aye.
Aye. Any opposed? Thank you very much. That's a very good bill, by the way.
All right. The next item is legislation requested related to reemployment of retired sheriffs. So generally in the pension law, there's a requirement that employees have a break in service after they begin receiving retirement benefits before coming back to work for a participating employer. And actually the counseling process and language in the documents when someone goes to retire indicate that, you know, the retiree or the member who's retiring should not be having any conversations about being reemployed to avoid running afoul of IRS rules and regulations and law. The system has become aware of a situation in the law enforcement officers pension system where you would have a county sheriff retire and then shortly thereafter be running for re-election. And I think in the instances references, they were running unopposed. And so there was concern that this was running afoul of the reemployment standards that a member would need to file in terms of not kind of having a pre-existing arrangement to come back. The board has recommended legislation to prohibit a member from LEOPS from retiring while running for elected office. In your documents, I also have an alternative option would be to consider addressing the issue by looking at using a suspension of benefits route. This is something that exists already for individuals of the employee system who become judges. For those retirees, their benefit is suspended while they're serving as a judge. And then when they leave that position, it resumes. Similar provision is also applicable to retired governors, and then also certain retirees who are on disability retirement. You know, the approach of suspending the benefits could also avoid a situation where if you're prohibiting a retirement prior to running, somebody could retire and then still find a way around the situation by then just filing to run after they've retired. And so it might not necessarily resolve the issue in a way that a suspension of benefits would. For the suspension of benefits too, it's the retirement's already processed. Member can choose when to retire. They've locked in their benefits. All the survivor benefits that are applicable to that are also there in place. And then for the other instances where this approach is used, when the member leaves that position and their benefits resumed, the cost of living adjustments that would have accrued during that time are also catched up. So they're not losing anything in that situation. So there's yeah. So we have two options before you. One is the option A would be prohibit them from retiring while running from office, and then option B would be utilizing the suspension of benefits route to curtail the situation where it may not be a by the books process, and then they're gaming the system to avoid the 45-day break.
Mr. Chairman, If I can
Yes.
just add to what Philip was saying, I don't know
Absolutely.
if this will weigh into your decisions on which option you choose, but Philip has been working with the agency on the second option, and we are perfectly comfortable with that option and have already started helping him, not helping him, but working through drafting what that proposal might look like. So we have no issue with that option either.
Thank you, Senator Huddleman. I see your hand.
I was just gonna make a motion that we adopt the second option.
I second.
Any further discussion? All in favor?
Aye.
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 Aye. Any opposed? All right, thank you all very much.
The next item is a correction. If there's an incorrect reference to a LEOPS contribution rate in a certain section of the statute. It was the 4%, which is the pre-2011 rate, but obviously it's a 7% contribution rate. So this would correct that reference to reflect the existing contribution rate for LEOPS members.
Is everyone clear on that? Could I get a motion?
It's technical. I make a motion that we do option A.
Thank you.
Second.
Second. Second.
Thank you. Any further discussion? All in favor signify by saying aye.
Aye.
Any
Aye.
opposed? Aye. Any opposed? Thank you.
Next one is also under the under the title of involving transfers of service. When a member individual retires within 5 years after transferring from one system into a new system. Currently, the agency has to conduct a sort of bifurcated calculation, adding together the different retirement allowances, and this has just become unworkable and kind of a mess. So this would repeal that 5-year requirement for benefit calculation.
Make a motion that we do option A. Joint committee will sponsor the legislation.
Okay, could I get a second?
Second.
Thank you.
Second.
Thank you. Any discussion? Anyone? Delegate McCaskill?
No discussion.
Okay, thank you. All in favor signify by saying aye.
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 Aye. Anyone opposed? Thank you very much.
All right, so the final legislative issue has to deal with extraordinary salary increases. So provisions of the code currently provide that when calculating a member's benefit, the average final compensation does not include a salary increase if it's considered an extraordinary salary increase. Current law does have an exemption for a salary increase related to a promotion, and then the remainder of the conditions are deferred to the agency to be adopted by regulation. And currently, there is in regulation a 20% threshold. So if a member's compensation were to increase by more than 20%, that could be considered an extraordinary salary increase. This is generally relevant for a member's average final compensation, which would either be the final 3 years prior to retirement or the final 5 years, depending on whether they were pre or post 2011 reform. And so the issue that has arisen is that recently a number of state agencies and units have had review of the employee compensation. And as a result of some of that review and those studies, there have been adjustments to catch employees up, bring them back up to what's considered adequate compensation for the services they're providing. And the system has found that in a number of instances that has actually resulted in employees receiving or exceeding that 20% threshold. And so as a result, part of the issue is that as there are more of these reviews happening, the the possible pool of employees increases, and the way the agency deals with these is on a case by case basis. So they're having to kind of go through and see all of the employees where this is being impacted. And so they've recommended a few options for you all to consider to address the issue. The first would be just do nothing, leave the status quo as is. So that 20% threshold, if that's impacting somebody's benefit calculation, the increase we backed out down so that it would just be up to 20%. So anything exceeding the 20% comes out of that calculation. The next options would be to reduce the period of time by which the adjustment is factored in. So currently it's either 3 or 5 years. The options proposed were either to make everybody 3 years, which that would not have any impact on any of the pre-reform members who are going to be the members that are most likely to be retiring sooner. All the post-reform people would be at a later date. There's also a suggestion to reduce it to 2 years, or also increase the threshold from 20% to 30%. There was a third option that was presented, which would be to kind of exclude an increase from being considered an extraordinary salary increase when it's related to a review of the compensation for employee classifications and positions. The agency noted in its write-up that, this provision dates back to, I think, the early 70s, and it's highly likely that, these types of salary reviews were not something that was being contemplated and being done at the time. But the one advantage of this option is that you're linking it to a more formal process that is more widespread. So generally the issue of the extraordinary salary increases is typically kind of viewed, and the way they do it is on an individual basis, whereas what's happening now is you're having broad-based compensation adjustments, and those adjustments are generally in a situation where employees' compensation has been lagging. And so it's the adjustments, while they may be exceeding that 20% threshold in instances, they're generally in the nature of bringing employees back to kind of a middle point or more reasonable compensation reflecting what other states or jurisdictions are paying or comparable employment. And so those are the three options. So that third option would just add an additional exemption for when there's a compensation increase related to a salary review that's adjusting the position classifications as opposed to just targeting a particular individual for an increase.
All right, any questions for further clarification? Delegate Mangione.
Thank you, Mr. Chair. I just want to make sure I'm understanding council correctly and I'm not confused. You're saying that a retiree gets a 20% or more salary increase, and then you're saying they're retiring very shortly after that, and then they're retiring. Obviously, we just gave them a nice package to retire in, but we're losing that worker, then I have to hire someone else paying the higher pension. And you're saying we're trying to correct that, correct? So I just want to make sure I'm understanding the big picture.
Yeah, and just to be clear too, so already our benefit calculations involve what's called average final compensation. So depending on when the member began service, it would either be a 3-year window or a 5-year window. So if somebody in that 3-year window, for instance, got a 25% bump and retired a month later, that increase would only be really impacting 1/36 of the total calculation. Whereas if that member, kept going and worked more than 3 years, all of it would be included, just as newer employees. So if again, when you're talking a broad base, so if they took a position classification and gave it a 25% bump, employees who had been there 1 or 2 years or 10 years versus employees who have been there 25, 30 years, the factoring of that compensation adjustment wouldn't really be equitable amongst all the employees, because the ones who would retire within their calculation window wouldn't be getting the benefit of that increase, whereas the newer employees would be working much longer, and it would already be factored in.
Thank you.
Good.
Delegate Metzger has his hand up.
Yes. Does this happen often, or is this something?
No, and I think so. So one thing to think through too is, so when you're talking, these broad-based, position classification changes, first of all, it's typically a smaller subset of employees. And then within that smaller subset of employees, really the ones that are only being impacted are the ones that are within a few years of retirement age. And I think in the systems testimony, I think in the last few years, they've seen one or two of these instances.
That's right. That's right, Philip.
Yeah, but this legislation was in anticipation of the review of compensation that's been undergoing. And so kind of wanting to get ahead of the issue.
I just want to make sure we're not trying to create another problem.
No, I think, Senator, from the agency's perspective, we right now, Philip is right. We had one instance in the last 2 years, but just in looking at the two agencies that I include in my write-up, and that's just two agencies. If 13, there could be a 14 potential immediately, going from 1 in 2 years to 14, which is not crazy. I know you're thinking, well, 14, that's not a big deal. It just seems like a big jump to us from 1 to 14. And that's really why we're calling it to your attention, because this is just two agencies. And if what we're hearing is true, that compensation studies are being done across the board for all state agencies, that number is just going to go up. And that's really, like I said, why we brought this to your attention, because there are going to be more than just 1 every 2 years.
Okay.
And so the option C that says that if these extraordinary increases came through a compensation study, that they wouldn't be applicable to the law. They would be
right. Similar to
and if
sorry, Philip.
Go ahead.
I was going to say similar to a promotion. So currently
Right.
There's an exclusion for a promotion, and the regulations also have exclusions for somebody who were elected to public office. And had an increase through that route.
And am I correct in an assumption that these studies were done and people were probably being paid under market values for many years?
Mostly.
So this would have gotten them to the midpoint of what, or something like that. Like
That's right.
Yes.
So is there more discussion, or?
I see Senator Hellman has her hand up.
Thank you, Mr. Chairman. I was just going to offer, I think it makes sense. I mean, we're going through this whole scale evaluation of compensation in the context of needing to fill vacancies in our state government. And so it's a systemic look. And so I think it makes sense to have a systemic response to it. So I think the third option is the way to go here. And I'm assuming
I think we lost you for a moment, but were you making a motion for option 3?
We lost her, but I'll make a motion for option C.
Second by McCaskill.
Yes.
Any further discussion? Thank you very much. All in favor, signify by saying aye. Any opposed? Thank you very much, folks. And I think that wraps up our decision segment of our agenda. We will move on to our annual state retirement and pension systems investment overview. That'll be Philip, Martin, Robert, and Ms. Hand. Proceed when you're ready.
Thank you, Mr. Chair. Philip Anthony with Legislative Services. I'll be presenting the investment overview for fiscal 2023. First, I'd like to thank the system for their assistance in preparing the overview. CIO Andy Palmer, Deputy CIO Robert Bird, who's here with us today, Martin Noven, the Executive Director, and Ann Gothrop, the Legislative Director. We'll begin by starting, and actually I can share my screen. We'll turn to page 3 for Exhibit 1. And this exhibit is showing the system's asset allocation and in relation to the allocation targets. And the reason we kind of lead off with this is that the system allocation is going to drive the overall performance of the investments over the course of the year. And it's, as you'll see, the actual allocation is tracking fairly close to the targets. The board reviews those targets at least once a year, if not at multiple times throughout the year with its investment consultants. And I would note that typically what will happen is you'll see fluctuations in the allocations, in the actual allocations based on the asset performance. So, we've had some years where you've had a really significant return in a particular asset, and that can skew the actual percentage of the system trust that is taking up. And the system investment division does monitor this throughout the year to make sure that the actual allocation is reasonably in the range of the allocation targets, since those are the targets are largely set by the board under multiple considerations, but a primary one being to mitigate the amount of risk the system is taking on through its investments by also setting itself up in a position to reasonably achieve the assumed rate of return necessary to fund the system adequately. And that's currently set at 6.8%. Turning to page 5, Exhibit 2, we have here the system returns for the fiscal year. So the total system return, 3.14%. All these values are net of any management fees. This was below the assumed rate of return of 6.8%. And then, although the system did exceed its policy benchmarks for the system as a whole, as shown here in Exhibit 2, we've hit a market value of 65.2 billion compared to 64.6 as of the end of fiscal 22. System returns were driven primarily in the public equity and credit asset classes. As a whole, the system's long-term performance has exceeded the return target of 6.8%, though I would note that on a 5 and 10 year period, the system's return assumption was a little bit higher. It has come down over the last few years. Moving on to Exhibit 3 on page 6. This is showing the system returns by asset class relative to the performance benchmarks. And as you'll see at the bottom, on a total fund performance, the system performed almost a full percentage point above the return benchmark. Again, this is important, showing that despite not achieving the assumed rate of return, the implementation of the system's investment policies is generating excess returns over what would be expected had it performed just to the benchmark. So our first request for comment to the system would just be to comment on the 2023 return performance in relation to the benchmarks, and for any assets or sub asset classes that are underperforming the benchmark. What are the factors leading to that underperformance, and should we expect something similar in the current year? And if so, what steps are being taken to mitigate those issues? The next section of the overview relates to performance relative to other systems. So here on page 7, Exhibit 4, this is showing the TUX rankings for systems greater than 25 billion. As you'll see here in this far right column, on the 1-year basis, our ranking was 96 out of percentile of 107. And TUX 1 is the highest ranking, and 100 would be the lowest. I would note that the system has historically had a low allocation to equity investments compared to its peers. And so when you're looking at comparative returns, as we started out with that first exhibit 1 about the system allocation, the allocation is going to drive the overall performance of the system. And so when you're comparing to peer systems, if you're looking at it on a whole, you lose a lot of insight as to what actually is driving that if you're not looking at the differences in how the system is allocating its investments among the various asset classes. We would also note that within our public equity allocation, the system does not have a bias to domestic equity like some other systems do. And so when you have years where, a particular asset class like domestic public equity does well, when you have a relatively lower allocation to that, your performance is going to skew on the lower end, as we see here what happened in the last year. However, I think this is probably one of the more important exhibits we'll see on page 8, exhibit 5. You have the TUX rankings by each type of asset. And so this is really more of an apples to apples comparison, because this is showing how our system is performing, basically doing the same thing that other systems are doing. So you're removing that element of underweighting, overweighting a particular asset class, and just looking at how we do on an individualized basis. And the first thing you'll notice with regard to equity, you'll see in the first column here on the left, under the 1 year, the total equity performance is still relatively low and 71st percentile. But then when you go down into U.S. equity, it's in the top quartile, 21%. And so, this is illustrating that issue I was discussing just now about how, without our bias towards U.S. equity, that other systems have, that's impacting that total equity performance by kind of dragging it down. But as you'll see with respect to the other asset classes, again, we have significantly better performance, over the short and longer term, which is indicating there is, prudent management regarding how those investments are being implemented. We did have a couple of requests. You'll see that we've asked, it's kind of a yearly request, just for the system to comment on the relative TUX performance rankings by asset class, and then how the overall allocation impacts the total system's TUX rankings. And then we did experience a few instances. If you see fixed income over the past few years has had a significant dip in its ranking. And so we've asked the system to comment on, what's impacting that. And then we had a dip in private equity, which is, as you'll see in the long term, has been top ranked amongst plans. And this universe of plans is a larger universe because this is systems with more than 1 billion. Moving on to for the discussion on page 9, I've said this fairly often, as a plan sponsor, the General Assembly, volatility is your main enemy. Volatility in investment returns are going to affect your contribution rates, and positive and negative. You'll have what you don't want to see as a plan sponsor for budgeting purposes is wide swings in your contribution rates, and that'll be driven by your investment returns. So the board has taken steps over the years to allocate the investments in a way that's going to try and best achieve those return needs, but also limiting the amount of risk that the system is taking on. And the TUX data does also provide that, over the evaluation periods, that our risk level was below the median for other public funds, but also we're still getting better risk-adjusted returns than many peers. And one further note on this topic is that regarding volatility, that we've had an allocation strategy that has been aimed at kind of keeping volatility minimal, and you'll see this kind of played out in the last couple of years. So this year we had a 3.14% return. Last year it was a negative 2.97% return. But a couple of years ago, when we experienced that negative return, you had many other plans having significantly larger losses. And so In order to make up for those losses, it would necessitate a higher level of investment risk to kind of catch up from those poor years. So our next request is just again to comment on how the system's allocation strategy has mitigated investment volatility over the past couple of years. On page 10, Exhibit 6, showing the systems management fees. System incurred $434 million in investment management fees for fiscal 23, a decrease from $569 million in fiscal 2022 fees, as well as a decrease in fees paid as a percentage of the assets. The fees will also fluctuate generally based on assets increasing and decreasing. Review of the systems fees generally by the systems investment consultant has multiple times noted that the system has been effective at negotiating favorable fee arrangements for the systems. And then also over the years, transitioning assets to internal management going forward is expected to result in fee savings to the system. As we'll discuss later, the system has, as of fiscal 23, moved $12.8 billion in assets into internal management, which is about 20% of total system assets. In prior discussions, the stated goal is a target of as much as 50% of assets being internally managed by 2028, which would be the 10th year of this internal management plan. Another feature related to fees is active management of assets. And as you'll see in Exhibit 7, we have a comparison of the system's actively and passively managed assets in a few asset classes. And while active management of assets will generally result in higher overall fees, the system has benefited from active management. When it makes sense, the system uses passive investment strategies where effective, but active management is able to add elements of diversification to system investments, and also it allows the system to be a little more nimble and able to make tactical adjustments when there are short-term or rapidly developing market conditions. So as you'll see in Exhibit 7, for nominal fixed income, the active management did outperform the passively managed assets by avoiding more substantial losses. And then I think another significant piece too is in actively managed U.S. equity, it outperformed the passive management. And that's fairly significant because the U.S. domestic equity markets are pretty efficient, and it's generally pretty tough to achieve returns in excess of the available indexes. I would note that during the year, the system had liquidated its emerging market equity passive investments. And I've had some discussions with the system. The values you'll see here may be a little skewed because of that in terms of the reporting, but nevertheless, we still have asked the system to comment on the strategy to allocate the emerging market investments fully in active management, and the impact of allocating a portion in passively managed index fund. The next item on the bottom of page 11 and going on to page 12 has to deal with absolute return fees. So these are typically investments that involve a base fixed management fee as well as incentive compensation based on performance. In 2023, the fees paid were about just under $94 million, which represents 22% of all management fees for the year. The asset class comprises 5.9% of the system's investments. So with the exception of the fiscal 21 returns, the absolute return has consistently performed well below the system's assumed rate of return, as well as performing below its benchmark. In fiscal 23, the asset class had a negative 1.3% return against the benchmark of 1.41. with a number of managers achieving asset returns below the benchmarks. For each of the periods, 1, 3, 5, and 10 years, the returns have been below benchmarks. Since inception, it's been slightly above 3.16 against the benchmark at 2.64. But we do contrast against the system's cash asset allocations, which have consistently performed better than the absolute return. And so given the historic low rate of return and the underperformance relative to the benchmarks, we've asked the system to comment on the absolute return asset class, including market conditions that they would anticipate leading to improved performance. On the bottom of page 12 is the discussion of private equity fees. So similar to the absolute return, these are assets that generally involve a high level of active management. So again, you have a base management fee plus a portion of earnings, which is referred to as carried interest. So for this analysis, the fees included for private equity are just the management fees. They do not include the carried interest. And for private equity, the fees comprise 29% of total management fees, while private equity was a little bit under 22% of system assets. However, in contrast with absolute return, private equity has consistently had very high returns. Although this year the return was only 0.26%, that was against a benchmark of negative 2.86. And looking at the 1, 3, 5, and 10-year periods, the returns have been 0.26%, 23.77%, 17.16%, and 16.42% respectively. And for all those periods, the returns were also in excess of the asset class benchmarks. And then, as you saw in Exhibit 5, our private equity portfolio has consistently outperformed its peers and is ranked in the top 1% for the 3, 5, and 10-year long-term targets. With regard to private equity, the system has been utilizing what's called co-investments. So this is adding additional investment capital to private equity funds that we're already, the system's already involved with. And the benefit of this is that it doesn't involve the typical heavy fee structure. And so we're effectively reducing the system fees when the investment division engages in co-investing by increasing funds with assets that we're already invested in. The small potential downside is that you could see a decrease in diversification, but management of that can mitigate those issues. The last item on private equity is something a little forward-looking. It probably hasn't manifested yet, but in August of 2023, the Securities and Exchange Commission had adopted new rules regarding private fund advisors. Compliance with these rules is kind of on a delayed schedule, and so it's between 12 and 18 months, depending on the activity or the size of the fund advisor. However, in November 2023, there was a court challenge filed by industry trade groups. So we just asked the system to comment on two things related to private equity, just an update on estimated carried interest for the calendar 2023 year, and then any anticipated short and long-term impacts on the system's private equity investments related to the new SEC rules. The next item for discussion is the investment division staffing. In 2018, chapters 727 and 728 granted the board authority to set the compensation of personnel in the investment division, in addition to establishing positions within the division subject to certain limitations. The investment division now is off budget and funded as a system expense. It was initially, when this came up in 2018, the discussion was centered around the system having the ability to create positions and set compensation would significantly help the system with both recruitment and retention of necessary division staff to perform its functions. as at the time it was having the compensation structure was not competitive, and employees were leaving by being maxed out on their current compensation. Since the passage, the system has been able to hire additional staff and also progress with moving forward on internal management of assets. The division has grown to 46 approved positions since passage of the legislation. And then the legislation also provided a pretty important feature, which was the creation of an objective criteria committee. And this committee is charged with reviewing the compensation for the investment division and making recommendations to the board regarding the exercise of that authority for compensation, and in particular with respect to incentive compensation, which was also authorized under the legislation. I would note that the legislation did include a number of limitations on the board's authority. The restrictions were intended to strike a balance between giving the board the necessary flexibility to recruit and retain essential division personnel while also being respectful of broader compensation available to other state employees. Consistent with that intent, the authority granted the board was a narrow authority to set competitive compensation for positions that are unique within state government, namely exercising discretion over investments of the trust supporting the system membership. The legislation also required incentive compensation to be granted based only on objective criteria adopted by the board. This interim, the Objective Criteria Committee has been meeting, and at its November meeting, there was a presentation by the board's consultant reviewing the compensation, and there was discussion amongst the committee about striking a balance between base compensation and incentive compensation. The discussion noted that incentive compensation can align an employee's interests with that of the system to encourage strong management performance. And that higher base compensation could have the result of rewarding underperformance. However, on the other hand, DLS would note that during the passage of chapters 727 and 728, there was a lot of discussion around the risks that higher weight toward incentive compensation could incentivize investment decisions that are more short-term while managing system assets. There was also discussion about how the legislation has impacted division recruitment and retention. There was discussion that while some positions have been more competitive to recruit due to national labor market issues, very few employees have vacated their positions since the passage of the legislation. DLS would also note that state agencies have been at all-time highs recently, and much of that is attributable to low compensation for state employees. And we would note that as it appears the investment division is faring better than other state agencies in terms of retention, it would suggest that the compensation has the authority given to set the compensation, and the compensation has been more in line with meeting that purpose than other organizations and other state units of government. So on page 15, we would just request an update on the use of the compensation adjustment authority and whether the board's faced any difficulties recruiting and retaining staff since the passage of the legislation. We've also requested the agency update the committee on the number of resignations and terminations since the passage of the legislation. Statutes also, as I said before, allowed for incentive compensation. The legislation did include a requirement that conceptually it was intended as a retention incentive, and so board incentive compensation is paid out over a 2-year period. And the next request is just an update on the use of the incentive compensation for recruitment and retention and the number of division staff eligible for compensation based on the 2023 returns. The criteria is largely weighted towards performance of the assets under management by each individual employee. Moving on to discussion of internal management of assets. As we said before, one of the second intended purpose of the 2018 legislation, the first purpose was to shore up and adequately staff the division. The next was intended to give the system the flexibility to build out its internal management of assets, largely to reduce the fee weight on the assets. So as we're managing things internally, it's not going to have those associated external management fees. So it's estimated that I think 1 basis point in fee savings would net the system approximately $6 million currently. And turning to page 16, we see here on Exhibit 8 the system's internal management of assets. And as I said before, it's about 20% of system assets, and the internally managed assets have generally exceeded or tracked closely with the asset benchmarks. The internally managed assets do, as I said, do not carry the same fee expenses, and the performance shown in Exhibit 8 does not reflect any fee savings. On page 17, we have asked the system to comment on the estimated fee savings attributable to the internally managed assets, and then our request for an annual update on the progression of the expansion of the internal management. On page 17, we have a brief discussion of the system's implementation of the climate risk legislation. In 2022, legislation was passed kind of solidifying the fiduciary responsibility for prudent management of the system assets to have a better understanding of climate-related risks to investments, including becoming aware of potential risks to current assets, as well as potential for future opportunities to invest as climate risks manifest. The Act does not require the system to take any specific action for any particular asset. Instead, the goal is to ensure that the system fiduciaries are well informed of the potential climate-related risks to system assets, just as they have duties to stay informed of any other financial risks to system assets. In many ways, the acts codify existing practice that the system is already implementing. And so on page 18, we've just asked for an update on the implementation of chapters 24 and 25. Exhibit 9 on page 19 shows the system's Terra Maria performance. Terra Maria program is the system's emerging manager program. In 2023, total assets increased to 2.4 billion, up from 2.2 billion in fiscal 2022. And as a proportion of total assets, Terra Maria increased from 3.4% of total assets in fiscal 2022 to 3.7% in fiscal 2023. As a whole, the program experienced returns of 10.25%, which slightly underperformed the benchmark. But of particular note, the actively managed Terra Maria portfolio had significantly better performance in its rate-sensitive assets compared to non-Terra Maria assets. For U.S. nominal fixed income investments, Terra Maria returned minus 0.1%, compared to returns of minus 0.88% for actively managed non-Terra Maria investments and minus 4.41% percentage returns for passively managed investments. And then the final item I have for you today is the system's currency program. This was adopted in 2009 to be designed to protect against the system losing value when the dollar appreciates relative to foreign currencies in which the system holds assets. And as of June 30, 2023, the currency program added a total value of $398.4 million since inception. The system also takes steps to kind of implement a little bit asymmetrically so they can lock in gains when available and then kind of pull back when the system is experiencing the opposite impacts. And Mr. Chair, Madam Chair, that's all I have for you today. I'll take any questions.
Thank you very much, Philip. Do any members have any questions or comments? As I'm scanning. No questions or comments? I think we got it, Philip.
All right. And
So, Martin or Robert, well, I guess up next is the system folks. Martin, Robert, and Ann.
Thank you, Senator Jackson, Delegate Forbes, members of the committee. Appreciate the opportunity to just say a few words. I'm going to talk very briefly because Bob's going to do all the heavy lifting. I know we provided you a good written response to all of these questions. Thank you, Philip, for the great work on this too. I should have said that. And so hopefully a written response is pretty thorough. It should do most of it, but we also have Bob Bird, who is our Deputy CIO, here to highlight a few of those questions and also answer any questions that you have for him. Before I turn over to Bob, though, I'd like to share Andy's apologies. Andy Palmer planned on being here. He had an unexpected medical procedure, and he's now recovering. He's doing well, but also honoring the doctor's wishes that he rest and spend a little time recovering. So he would have liked to have been here today, but that's why he's absent. We'll see him back very soon.
Make sure you give him our best, Martin. So thank you.
Thank you. So then, Bob, you're up.
Okay, can you hear me, Martin?
Very well.
Okay, good. Good afternoon, co-chairs Forbes and Jackson and members of the committee. My name is Robert Bird. I'm the Deputy Chief Investment Officer for the pension system. As Martin mentioned, we've prepared comprehensive responses to all the questions in the overview, and I'd be happy to discuss any of them or answer any questions that you might have. I would like to spend a couple of minutes talking about recent performance over fiscal years 22 and 23. This has been a pretty volatile time period as inflation has been high and the Federal Reserve has been active in raising interest rates to combat inflation. But before I do that, maybe a couple of words about the asset allocation. I think the DLS overview noted that the system's allocation is a little more defensive than most of the peer group in that we have less exposure to the more volatile asset class of public equity and a higher allocation to more risk-balanced asset classes like bonds, absolute return, and credit. So when stocks and other risk assets sell off, we typically do better than the peer group. And when stocks move sharply higher, we will be expected to underperform in that environment. And the board tries to control volatility because volatility eats into returns of a portfolio that is subject to cash flow requirements. Because if you have to sell assets to fund an obligation, invariably you're going to have to sell those assets at unattractively low prices, and it just takes a long time to recoup those losses. And since the system is in a negative cash flow position, meaning more money is leaving the fund to pay benefits than is coming in the form of contributions, it's important to control this volatility and try to help preserve the capital and avoid an extreme drawdown in asset value. So starting with fiscal year 2022, fiscal year 2022 is a very challenging year for the markets. Inflation was running high in response to supply chain disruptions and fiscal and monetary stimulus. And in response to that inflation, the Federal Reserve began hiking interest rates in March of 2022. And an environment of high inflation and rising interest rates is not conducive to generating strong returns in public stocks and bonds. In fiscal 2022, the system's stock portfolio returned negative 19%, while the bond segment was down 15%. And against this challenging backdrop, the system's net return for the fiscal year was negative 2.97%. And while that 2.97 is negative and low, and and it looks bad, it outperformed most of our peers in the universe. Moving on to fiscal year 2023, bonds continued to struggle as the Fed continued to hike interest rates. Our bond returns for fiscal 2023 were negative 3.7%. However, stocks rebounded sharply, particularly in the second half of the fiscal year, as the enthusiasm around artificial intelligence began to take hold. So in fiscal 2023, the S&P 500 index was up 19%, and the system's more defensive portfolio will lag peers in this strong equity environment. So in fiscal 2023, the system's return, as mentioned in the DLS report, was a positive 3.14%. So we had negative 2.97 in fiscal 22 and a positive 3.14 in fiscal 23. When reviewing that 2-year performance on a cumulative basis, the total return was essentially flat. It was 0.08% or 8 basis points. And to help assess or evaluate this result, it's constructed to compare it to a traditional portfolio of 60% stocks and 40% bonds. And over this 2-year period, that 60-40 portfolio had a return of negative 0.15% or negative 15 basis points. So the system outperformed the 60 portfolio on a cumulative basis over this 2-year period by 23 basis points. And this 23 basis points represents $159 million in added value over that 60-40 alternative. The system also benefited from having a lower volatility portfolio than the 60-40. Over this 2-year period, the dollar impact of the system's lower volatility was $356 million. So when you add up the $159 million benefit from the higher return to the $356 million from a lower volatility portfolio, you get a total advantage over the 60-40 portfolio of $515 million over this 2-year period. So, you know, the absolute return is not that exciting, but we are able to say that it beat that market alternative. And just to provide you with a quick update of the fund's performance fiscal year to date, our latest published returns go through October 31st of 2023. So for the first 4 years of the current, or 4 months of the current fiscal year, the fund had a return of negative 3.50%. However, since the end of October, the stock and bond markets have rebounded sharply. So I would expect that the year-to-date return through today would be slightly positive. And the market value of the fund as of the end of October was $62.2 billion. I'd also like to recognize the effectiveness of Chapter 727 and 728 that were passed in 2018. This legislation gave the board the authority to both set the number of positions as well as set the compensation for people in the investment division. And this legislation has been extremely successful in enabling the system to recruit and retain qualified and experienced investment professionals. Since 2018, the investment division has hired a total of 28 employees, 20 people on the investment side and 8 people on the administration and operations side. A portion of this growth was to remediate the level of understaffing that existed prior to the legislation. The remaining positions were dedicated to the internal management position and to add depth to the investment division and ensure a sustainable long-term staffing structure with appropriate succession planning resources. And as mentioned in the DLS overview, we have built out an internal management program. That's the first mandate was funded in 2019. We currently manage about $12.8 billion across 9 different public market strategies. And this $12.8 billion represents nearly 20% of the total fund. In addition to these public market mandates, staff has also invested over $2 billion in private market co-investments over the past few years. And since there are no management fees associated with the public markets and the cost structures of the private market co-investments are significantly lower than the market, we have realized significant savings from the internal piece of this. The estimate annual savings is currently about $27 million per year. And when you factor in the co-invest piece, the savings on the carried interest side is going to be much higher, because carried interest is typically based on a percentage of profit, usually 20%. So the dollar savings from the $2 billion that staff has committed to co-investment is expected to result in savings of $150 million. So we think that the internal program has been successful up to this point, and we think we can continue to expand it, transitioning more into active management. Up to this point, the strategies have been mostly passive, but we're in the process of structuring the accounts to give the managers more leeway to take more market bets in those accounts. So going forward, we think that we can save roughly $150 million per year. I'm not sure we can reach 50% of total plan assets managed internally, but I think we should be able to build on what we have accomplished to date. And I'd also say a couple of remarks about the climate risk bill. I think we've made significant progress since the bill was enacted. I think it was effective July 1 of 2022. We've hired a corporate governance manager to lead this initiative. Last February, so February of 23, the board approved amendments to the investment policy manual that incorporates all of the provisions of the climate bill. And in September of this year, the board approved a policy on engagement and advocacy, and that will enable the board to highlight high-level risks in the portfolio and target companies that are responsible for those risks. So that enables staff to embark on a more proactive engagement policy with the companies that we own. And that concludes my prepared remarks. Again, I'd be happy to talk about anything else or answer any questions you may have.
Thank you, Mr. Burt. Any questions or comments from anyone? Senator Heldman.
Thank you, Mr. Chairman. And I know that you had just mentioned at the end there the climate risks. And my understanding is from the legislation that we passed that those assessments are supposed to be done by asset class and supposed to get into pretty decent detail. And I don't know, I just felt like we just got kind of a big picture view And can you just talk a little bit more in depth about where you are in the process of taking a look at those climate risks, and the sectors that are most likely to pose the most significant risks to us?
Yeah, so we've been posting an annual risk assessment for the past several years. Last year, we added the climate risk requirements to that annual risk assessment. And due to the limited amount of data that we have, the climate risk was limited to, I think there was the public equity asset class. But going forward, we are reviewing other applications and software models that will help us or assist us in expanding the reporting in that annual risk assessment. So we do realize that it's been limited up to this point, but our plan is to expand that as much as we can, subject to the availability of measuring tools.
Okay, I would just, I don't know kind of how wide it seems like you would be permitted to go fairly wide in terms of what kinds of information is you're using to calculate those risks. But I mean, just as an example, there's been all kinds of predictions about, peak oil demand. And I've just have some research here that says the International Energy Agency produced a report that predicts oil demand will peak before 2030. And obviously that has an impact on fossil fuels. So, that seems like it would be something that you would want to look at closely in your portfolio. And I just want to know if that is sort of set up system-wide to take that kind of look.
Right. We are aware that the high risk sectors regarding climate change are energy, utilities, and basic materials. So those will probably be the areas that we will focus on initially in terms of engagement and measurement.
And when do you think we could expect to see that more granular analysis by asset class?
I'm not sure about that. I'd have to get back to you.
Okay, thank you.
Yep.
Madam Chair, sorry.
Thank you, Mr. Chair. And I'm following up on Senator Hedelman's questions. This is a legislation has been followed by a number of environmentalists, constituents of mine, and across the state. So anything we can do publicly to share with them what you're doing would be appreciated. They're following it, they're asking us questions, and anything that can make it accessible to them, the information accessible to them, would be helpful. Thank you.
Yeah, and I'll add that the annual risk assessment is posted on our website. So I would encourage you to go to the website and review that.
Okay. Any other comments?
I can, Madam Chair, I'll talk to Bob after the meeting. I know it can be a little bit difficult navigating our website sometimes, so I will get links and get them to you directly, so you can just click on them and not have to try and do a search and find.
Thank you very much. I appreciate it.
Yes, we'd appreciate it for the committee. So often, many of us will need help as we gear up for January. So any other questions or comments? All right. Andy, you have anything?
I'm simply here for moral support for my team, Mr. Chairman.
And for us. So what I want to say before we close out today is, and are we to that point, or do we have more coming? I think we should be there, correct?
That's everything.
So let me say, I appreciate everyone's time and attention for the members as we navigate these pretty challenging times, but I think it's we have a terrific opportunity with the team that the state has and the relationship we have with our analysts and as we go forward. So I want to thank you for your time and attention during the interim. Wishing everyone happy holidays and happy and safe holidays, and speedy recovery for Dean. Madam Chair, if you have some closing remarks before we adjourn, please feel free to proceed.
Thank you, Mr. Chair. I just wanted to thank Mr. Byrd for stepping in such short notice for Mr. Palmer, and that we wish Mr. Palmer a speedy recovery. And thank you all for being here tonight. And I wish you all a really nice holiday season. And we'll be together soon in the new year.
Yes, we will. And get some rest, folks. It's going to be a good one.
Yeah, Senator, if you don't mind, I'd just like to say Happy Hanukkah, and we need to pray for the peace of Jerusalem. Very, very important of any time right now.
Absolutely. All right.
Thank you.